Welcome to our reading on financial reporting standards, which is really a good cure for insomnia. Let's have a look at our first learning outcome. This learning outcome asks us to describe the objectives and importance of financial reporting standards in security analysis and valuation. And look, we've got this conceptual framework from the International Accounting Standards Board that we covered in an earlier reading. And remember, this is really talking about the objective of financial reporting, and it's extending it to more than just the shareholders. So yeah, we are reporting to the shareholders, not just the current shareholders, but also potential investors. And it goes beyond shareholders. We're looking at lenders and, of course, other creditors as well. Lenders being the providers of debt finance to the company, other creditors could be tax authorities, etc. So really it's anybody that is actually either buying, selling, or either debt or equity securities. So it goes beyond simply just shareholders. Okay, so let's have a look at the roles, and our LOS asks us to describe the roles. What we're looking at here is the US system. Now notice we've got up there the American Institute of Certified Public Accountants. These essentially are our auditors. And over the other side, we've got the Securities and Exchange Commission, SEC. Now, of course, they're going to regulate you if you're a listed company. It's worth just being a little bit aware that the SEC themselves do have the authority to actually establish accounting standards themselves. However, they don't really in practice. They leave that to the Financial Accounting Standards Board. So let's look at the Financial Accounting Standards Board. Notice both the audit firms and the SEC recognize the role of the Financial Accounting Standard Board. These are going to be the guys that actually set the financial statement reporting standards. Okay, so these guys set the accounting standards. Now notice what we've got there is two things. The Statement of Financial Accounting Concepts. This is really a framework of principles, and the Statement of Financial Accounting Standards themselves. These are the detailed accounting standards that talk about individual transactions and how they need to be accounted for so that we're reflecting the economic substance of those transactions. So that's how it's working in the US. What about elsewhere? Well, we've talked about the standard setter being the Financial Accounting Standards Board in the US. In most other countries around the world, it's the International Accounting Standards Board, the IASB. Now, in exam questions, you're meant to assume that you're looking at international accounting standards unless your examiner specifically tells you US GAAP. So international accounting standards are your default position for our exam. Now, these are the standard setting body. This is the standard setting body of the IFRS Foundation. And the IFRS Foundation essentially goal really is one unified set of accounting principles globally. It actually contains a board of trustees. Those trustees reflect the diverse geographical and professional needs. They appoint the members. So the members of the International Accounting Standard Board are appointed by trustees. So let's make a note of that. So the trustees essentially appoint the members of the International Accounting Standard Board and are responsible for monitoring the performance and effectiveness of the International Accounting Standard Board. The trustees themselves are further accountable to a monitoring board, and that monitoring board is made up of a number of different organizations. It includes, for example, IOSCO, and we're going to encounter IOSCO on a slide in just a second. It includes the European Commission. It includes the SEC, for example. Desirable attributes of standard setters. Now, I can imagine this is a very easy question to write. Which of the following is a desirable attribute of a standard setter? So again, it's a list to learn, and I would be aware of these. Okay, so first one, observe high professional standards. In other words, these standard setters are not going to be compromised by external pressures or special interests. So they need high professional standards. Have adequate authority, resources and competencies to accomplish the mission. In other words, they have the correct skill set and knowledge to be able to produce the accounting standards. Clear and consistent standard setting process. In other words, we're talking about transparency here. We're talking about a framework which has been applied and therefore the accounting standard has been generated using this framework and procedure. Then finally it says guided by a well-articulated framework. And what we're really saying there is it needs to have clearly stated objectives. Okay, so it's a list to learn, 4 factors that we need to take into our exam. 1, 2, 3, 4. Be on your guard for those. Very easy question to essentially write. Okay, now let's have a look at a few extra items that we've got in terms of our attributes of standard setters. They need to operate independently while still seeking input from stakeholders. Well, the independently means they need to be free from bias. But being free from bias doesn't mean you're going to ignore the opinions of all of your stakeholders. It just means you can't be unduly influenced by any particular group of stakeholders. So they are still going to seek the input. It's very important that the accounting standards that they generate meet the needs of the users of a set of accounts. And the users of the set of accounts, of course, are the stakeholders, from the company to investors to providers of finance. So not compromised by special interests. Well, again, really echoing that point of being free from bias. So you shouldn't be influenced by lobbying of particular interests, should be free from political bias as well. And notice, decisions therefore made in the public interest result in standards adopted by the regulatory authorities. Okay, so a little list of standards that we need to be aware of, attributes that we need to be aware of. Financial reporting and requirements. Now, we're still in describe our LOS. First one is the Securities and Exchange Commission, the SEC. Now remember, if you're a listed company in the US, then essentially you're going to fall under the remit of the SEC. And as we said before, theoretically they can set accounting standards, but in reality they delegate that role to the Accounting Standards Board. We've got the Financial Services Authority in the UK. Actually, to keep up to date, that's actually now changed. The FSA has actually been replaced in the UK. We now have 2 entities doing its role, the FCA and the PRA. FCA actually stands for the Financial Conduct Authority, that's actually interested in how customers are treated. And the PRA is the Prudential Regulatory Authority, which is far more interested in things such as capital adequacy. IOSCO is our other organisation here, the International Organisation of Securities Commissions. Now, essentially, this is a body that contains many securities market regulators from around the globe. Now, IOSCO, you can see we say it's got 181 members regulating 90% of the world's capital markets. Now, I did a bit of research the other day. We're actually up on this now to 199. Don't worry, I don't think the CFA in any way is going to ask you how many members do you have in IOSCO, so it's not a number you need to remember. But notice, we're actually talking about over 90% of the world's capital markets. So this is an organisation where the members themselves are security markets regulators, such as the SEC, such as the FSA. Now, the most important thing I think you've got on this slide is knowing what the core objectives are. So number 1, protecting investors, which of course is normally the primary guideline for a securities market regulator. So we're protecting investors given their level of expertise. Not all customers need the same level of protection. So protecting investors, ensuring fair, transparent and efficient markets. Well, of course, let's focus on transparent for a second. Transparent really means all information is provided in a timely fashion. And efficient markets, well, of course, we touch on efficient market hypothesis in the CFA syllabus. And what that really means is that share price capture all available information. So really, when they talk about ensuring fair, transparent and efficient markets, they're talking about all price-sensitive information being released to the market and disseminated within the market efficiently. And then the final one, reducing systematic risk. So in other words, reducing the risk of banking collapses such as the one that we witnessed in 2008, 2009. So very important that you take in those core objectives. Goal, uniform regulation. So what they're trying to do is provide uniform regulation of securities markets globally. So in other words, whether you're a customer in the UK or whether you're a financial services customer in the US, you should know roughly what rules apply to you and they should be consistent. Now, one thing to note with IOSCO is any rules that IOSCO generate are not legally binding on the actual members. So the SEC and the FSA don't have to adopt IOSCO's rulings. Let's turn our attention to a little bit of SEC filings and forms in terms of describing them. Again, here I think we need an awareness of what these forms are. I'm not sure we need to learn the numbers and exactly what each one is. S1 is often known as the Securities Offering Registration Statement. It's required whenever a company sells new securities to the public. So if you were doing an IPO, you would need an S1 form completed. But if you were doing a rights issue, so you're already listed but you want to issue further shares to the public, again, an S1 form wouldn't be needed. What does it contain, the S1 form? Disclosure about the securities that are offered for sale, so what the securities are and their characteristics. The relationship between the securities issued and any other capital securities. So let's imagine we were looking at bonds, for example. You'd be very interested in where the bond ranks on a liquidation, its relationship to other bonds that have been issued, is it secured, etc. So that needs to be disclosed. Information provided in the annual filings needs to be included in an S1. Recent audited financial statements will be included in as well. And also a statement indicating any risk factors needs to be included in S1. So a real detailed description of the risk potential of any investment. Let's turn our attention to 10K. This is the annual report that needs to be filed with the SEC. So two things that really happen to our audited accounts. One, they're included in the 10K along with other information and filed with the SEC. The other thing, of course, is they're put into published glossy accounts and sent out to the shareholders. Now, of course, the information that shareholders get, they get the statutory glossy accounts, but they get a lot of other information, which is really has more of a marketing element. So let's talk about the 10K. What's it going to include? It's certainly going to include any business and financial disclosures. It's going to include information about any legal proceedings. You get a historical summary of financial data, normally going back over 10 years, typically 10 years. It will include the management discussion and analysis, and of course, it will also include this year's audited financial statements. Def 14A, proxy statements. Now remember, every time a company's shareholders are going to vote on a resolution, then before that vote takes place, the proxy statements need to be filed with the SEC. And these are going to detail exactly what those shareholders will be voting on. So prior to the meeting, they need to be filed. Now, a really useful form for the analyst is the 8K, material events. Any material event that's occurred to the company. And what do we mean material? Well, again, I take material to be a price sensitive event. Any event that you think could have a material impact on that company's stock price needs to be disclosed. Again, this goes back to the regulator's requirement that markets are fair, transparent and efficient. So we need material events to be disclosed. It could be a new acquisition target. It could be a removal of certain directors, appointment of new directors, removal of audit firms, etc. Anything really significant has to be detailed in that 8K. Form 144, stock issues to qualified buyers without SEC registration. Yeah, I don't really think I have much of an interest in that. Forms 3, 4 and 5, maybe a little bit more important. What we're going to see in 3, 4 and 5 is share dealings with corporate insiders. Okay, so in other words, corporate insiders, managers, of course, are corporate insiders, employees, managers, but also beneficial owners of greater than 10% of the company's voting capital. So if you're a shareholder and you own over 10% of the company's shares, then you're deemed in this situation to be a corporate insider. And what these forms are going to have to disclose, therefore, is transactions, dealings with those corporate insiders. Form 3, essentially, is the initial statement. Form 4 reports any change in their shareholding. So 3 is telling you when they gained their initial shareholding. Form 4 is showing any changes in their shareholding. And 5 is just the data that would be reported within a 10K. Okay, so we can see, therefore, corporate insiders buying and selling shares within these forms. Our LOS changes now. It's still a describe LOS, but it's asking us to discuss the barriers to convergence in particular. So let's talk about convergence, global convergence of accounting standards. This is the idea of harmonizing accounting standards. Now, again, I think the most important thing here is to note, essentially, the reasons. So, 1, 2, and 3. Why do we want one unified system of accounting standards? Well, number one, increased comparability. Increased comparability. In other words, if you're an investor and you have a global portfolio, you want to know that the accounts produced in the UK have been produced using similar techniques and similar principles as maybe a set of accounts that have been produced in France, or a set of accounts that have been produced in the US. So it's really helping the investor improve their comparability, and helping the analyst, of course, improve their comparability, particularly when we come to calculate ratios. Decrease the problems and expense of raising capital in foreign markets. So, for example, until very recently, if you had a dual listing, let's say you were listed in the UK and in the US. In the UK, you would have had to produce your group accounts under international accounting standards, and in the US, you would have had to produce them under US GAAP. Now, again, as we converge, those problems are going away. It's more expensive to produce two sets of accounts. These days, you no longer have to do that. Decrease problems and expense of preparing consolidated financial statements for foreign subsidiaries. Well, again, of course, we're looking at lots of companies that are conglomerates with lots of different divisions dotted around the world. Now, again, what they're meant to do is, essentially, if they've got companies and their local accounts have been produced using local accounting standards, those accounts then need to be converted to the parent company's accounting standards when the statutory group accounts are produced. So the greater the difference between local accounting standards and the reporting company's accounting standards, the more work that it entails, and therefore the more expense. So the idea is really, this is all to do with improving comparability and reducing expense for companies. Now notice, of course, accounting standards for most major countries are converging over time with IFRS. Remember that goal of IFRS, to have one unified set of accounting standards globally. So what are barriers to convergence? Why haven't we got one set of accounting standards globally? Well, number one, differences in views. Accounting standard setters don't necessarily agree. So, for example, under US GAAP, when you look at long-lived assets like PP&E, your property, plant and equipment, under US GAAP, they require that to be reported at historic cost. Under IFRS, there's a choice. You can report at historic cost or fair value. In other words, you can revalue to market value. So there's a difference there, whereas IFRS believes that fair value adjustments should be made to PP&E or can be made to PP&E. US GAAP prevents it. So you do get differences in view. Another big one, of course, is pressure from business and industry groups. In particular, political lobbying that these accounting standard boards face. And we did see a lot of that. Particularly, a good example of that is in 2008, 2009, where the accounting standard boards were put under a lot of pressure to change how passive investments were accounted for, essentially. So the unrealized losses that were being caused by the credit crunch didn't hit the income statement. But essentially, in any situation where you've got lots of different vested interests and lots of different voices, all with interest, it's going to be difficult to obtain convergence. However, a lot of progress has been made. So when I was an auditor, which is over 20 years ago now, there were huge differences between US GAAP and IFRS. They were really, really different. These days, there are only a few remaining differences outstanding. So the process of convergence has taken place. We turn our attention now to LOSD, which asks us to describe the IFRS conceptual framework. So it's a describe LOS again, looking at our conceptual framework under IFRS. Now, the idea behind the IFRS conceptual framework is it should be used to generate new accounting principles, essentially. So let's have a look at our qualitative characteristics, two qualitative characteristics. Again, likely question in the exam, which of the following is a qualitative characteristic? So our first one here is relevance. Now, we've seen this numerous times. The relevance really is saying that the information must be useful for making economic decisions. Okay, so in other words, evaluating past performance, forecasting future performance, etc. It must have, therefore, predictive value or confirmatory value. So in other words, it should be used ex ante in terms of predicting the future, or ex post in terms of confirming the past. So our relevance. And the second one is our faithful representation. First of all, information is complete. In other words, all transactions are included in the set of accounts. It's neutral, so it's free from bias and free from error. Now, when I look at neutral and free from bias, I'm really thinking, look, we're reporting the economic substance of the transactions. And free from error is obviously the absence of material errors. Now, notice our faithful representation does have some sub-characteristics. Comparability, we should be able to compare data year on year. Verifiability, the data in financial statements should be able to be verified, and of course that's the role of the auditors. Timeliness, the idea here that financial data goes out of date very, very quickly. Its economic usefulness is going to erode over time quite rapidly. Therefore, there's going to be more relevance to a set of accounts the earlier they are released after the company's year-end date. Now, the problem is you do have a little bit of a trade-off between these two. If you produce the accounts very early, then they have more relevance because the data is that much newer and fresher. But trouble is, if you produce the accounts very early after the year end, verifiability suffers. So for example, if you wait a long time after year end, you'll know exactly how much of the year end accounts receivable was collected and how much defaulted. If you produce the accounts very quickly, you won't. So there's a bit of a trade-off there. And notice our fourth point there, understandability. Now the idea is the account should be understood by a reasonable user. What is a reasonable user? It's certainly not somebody without any accounting knowledge at all. It's somebody with a basic grasp of the accounting principles involved. And what we're saying is when they pick up the set of the accounts, they should be able to look at those accounts and understand the performance of the company and the position of the company, and in particular, the economic substance of the transactions that the company has undertaken. So, ideal to have all of our characteristics, but as we said, there is trade-offs, and we've already touched on one, the relevance versus verifiability. Number one, data is relevant if it's received very quickly. Problem is, as we said, if the accounts are produced very quickly after year end, verifiability suffers because we don't have a lot of data on the year end balances, such as the accounts receivable, how much was collected, etc. There's also a trade-off between the benefits of the accounts and the cost to prepare them. And of course, one big limitation is the information included in there is only quantifiable, the quantifiable information. In other words, monetary values, information where we can place a monetary value. All of the non-quantifiable information, the touchy-feely stuff, of course, is not going to be included in a set of financial statements. So let's have a look at our IFRS required reporting elements, and we're asked to describe the general requirements. An item should be recognised in the financial statements. Recognised simply means included. Okay, an item should be included in the financial statements if a future economic benefit from the item flowing to or from the firm is probable. Now, if it's a future economic benefit flowing to the firm, then we're talking about an asset. If it's an economic benefit flowing from the firm, we're talking about a liability. So we've got the definition of an asset and a liability in here. And notice when they're talking about the flow of economic benefit, we've got this key word here, it's probable. It is a likely flow of benefit to or from the company. And then finally, the item's value or cost can be measured reliably. In other words, this is all about, can we put a monetary value on the item? So, in other words, we're going to include an item in our financial statements if it results in inflows or outflows of benefits that are likely and we can ascertain the monetary value. So it then gets into a bit further definition of assets and liabilities. Notice an asset, a resource controlled by the entity resulting from past transactions. Fine with that definition. This is the one I really want you to take with you away from this reading. An asset will result, or is likely to result, I should say, in a probable future economic inflow benefit to the enterprise. Let's take our accounts receivable, our trade receivable. What's the economic benefit inflow? Well, of course, cash should flow in when the customer pays. Now, liabilities, of course, are obligations to third parties resulting from past events. Settlement results in probable resource outflow. So we said an asset is going to result in an inflow of benefit. A liability, therefore, results in an outflow of benefit when it is settled. So again, that's the definition of a liability I want you to take into the exam. Now, equity, shareholders' residual interest, we've already done this. We've said, look, take the assets, deduct the liabilities, and what you're left with is equity. So assets minus liabilities equals our equity. And remember, assets minus liabilities often gets that phrase or gets the name net worth or net assets. Here's our income definition under IFRS. Increases in economic benefits, enhancements of assets or decreases of liability. Now, I think we need to be careful on this. It's any enhancement of an asset that will result in an increase in equity. Any decrease in a liability, that will result in an increase in equity. So the key point with these two is they have to have an effect on stockholders' equity. I think probably a simpler definition to take into the exam with you is it's our revenues and our gains in terms of our income. Expenses, well, these are going to be the opposite. So these are going to be, if you like, decreases in assets or increases in liabilities that again affect our equity. Again, possibly a simpler definition. Think of it as being our expenses and our losses that flow through the income statement. So we then turn on to what required financial statements do we have per International Financial Reporting Standards, IFRS. IAS 1, the International Accounting Standard number 1, says these are the basic financial statements that are required. So our balance sheet, remember that is our company's financial position at a year-end date. The income statement, which of course is our dynamic statement, a statement of performance spanning the period between two balance sheets. Statement of comprehensive income, remember that takes the income statement and adds on any other gains and losses that have been taken directly into stockholders' equity. Changes in equity, a reconciliation of last year's balance sheet equity to this year's balance sheet equity. The cash flow statement, a reconciliation of the change in balance sheet cash from last year to this year, splitting it into our three classifications, our CFO, our CFI, and our CFF. Together, they give us the change in balance sheet cash. And of course, accounting policies and notes as well, the footnote disclosure. All, of course, of these primary financial statements are audited. Remember, the one thing we said that is normally not audited in most countries around the world is the management discussion and analysis. Certainly the primary financial statements, but also the footnote disclosure, the policies and additional notes will be audited. Right, so let's have a look at our fundamental principles under IFRS. So our fundamental principles: fair presentation, going concern, accruals basis, consistency, and materiality. Let's hit these one at a time. Fair presentation. It's back to this idea that we keep on coming back to, that the accounting principles selected by the company must represent the economic substance of transactions. So it's back to reflecting the true economic substance. Next one, going concern. The accounts are produced assuming the company will continue for the foreseeable future, at least to the next balance sheet date. If we set aside going concern, then the accounts would look very different. There would be no long-term assets or long-term liabilities. Everything would be current, because we would be looking at the company on a liquidation basis. So we do assume going concern. Accruals basis. Now remember, the income statement and the balance sheet are accounted for using this accruals process. We record revenues when the earnings are complete. In other words, sales are recorded when the earnings activity is complete, not when the customer pays us. And remember, we have the matching concept that says match costs against revenues. So we're going to match costs against our revenues as well. Meaning, of course, that profit or income, net income in the income statement is not the same as cash. So yeah, we're going to use an accruals basis. Consistency, well, this really says once a company chooses an accounting policy or principle, it should apply it consistently year on year. In other words, you can't chop and change your accounting principles year to year. There is a caveat to that. If you believe the economic substance of the transaction has changed, and therefore a new accounting principle would better reflect the economic substance of the transaction, then of course you can change it. But if you do change an accounting principle, you do have to go back and restate prior years as well. And of course, you'll find that detailed in the footnotes, but you'll also find the reason for the change in accounting principle detailed in the management discussion and analysis. Okay, so consistency year on year in order to aid comparability. And then our final one we've got there is materiality. Again, really it's saying we only really care that transactions are recorded accurately if they are material. And remember, this idea of materiality is items that are so significant that they would affect the perceptions, the opinions of a user of the accounts. Presentation requirements, aggregation where appropriate, says IAS 1. In other words, when we look at the balance sheet, we're likely to see one figure for our trade receivables, our accounts receivable. What we don't see is each amount owed by each customer separately. We're going to just group them all together. So we do aggregate assets and liabilities by their type. No offsetting. Well, this says, again, you've got to be a bit careful about offsetting assets and liabilities. So, for example, if you've got positive cash in one bank account, but negative cash in another bank account, in other words, one's overdrawn, you're not allowed to net those two together unless the banks involved allow you to. So if you were allowed to offset your two accounts together, then yes, you could show the net. But if they're held with different banks, that wouldn't be the case, and therefore you'd need to show one as an asset and one as a liability. Can't offset assets and liabilities. We see that in particular in the level 1 with deferred tax assets and liabilities. We might have both a deferred tax asset and a deferred tax liability. We're not allowed to net the two together. We're going to see that we have a classified balance sheet. Items are going to be classified by type and also by timing. The financial reporting standards themselves give you the minimum information on the face. So this is the minimum information that companies must provide on the face of their financial statements. They can provide more if they want, but they can't provide less. Likewise, not only minimum information on the face of the primary financial statements, but also the minimum disclosure in the footnotes as well is stipulated by the accounting standards. Again, companies could provide more if they want, but they can't provide less. Final one we've got down there is comparative information. So in other words, when you look at a set of financial statements, you don't just see this year's balance sheet and this year's income statement, you also see the prior year as well. And again, this is to enable investors to make comparisons year on year. Our next LOS changes to a compare LOS, and we're comparing framework differences between IFRS and US GAAP. Now notice IFRS, when they talk about performance, is really talking about the income statement, so it's talking about income and expenses. US GAAP actually extends that. Notice they say revenues, expenses, gains and losses. Now just be aware, of course, when we talked about income earlier, income really includes gains under IFRS. Expenses really also includes any losses. Now remember, the gains and losses are gains and losses outside the normal course of activity, such as asset disposals, such as early retirement of debt, etc. So yeah, okay, they're broadly the same there. Comprehensive income can be shown in the bottom of the income statement under US GAAP, can be tagged onto the bottom of your income statement. It's shown as a separate statement under IFRS. Definition of an asset, well look, a resource from which future benefit is expected, so it's a probable flow of benefit under IFRS. US GAAP doesn't make that mention of probable, it's just a future economic benefit. All right, so one saying probable, one saying not saying it. Upward revaluation, I think this is probably the most important one here. In particular, things like PP and E and intangibles. Allowed under IFRS. So you've got two choices. You can either use a historic cost convention or you can revalue. And again, we'll talk about that in a reading later on. Under US GAAP, typically revaluations to fair value are not allowed for most assets. The exception under US GAAP is some financial instruments which are allowed to be recorded at fair value. But certainly PP&E and intangibles, you can't record at fair value. Instead, use a historic cost convention, which means purchase price less accumulated depreciation. Right, our next LOS is identify characteristics and barriers to a coherent reporting framework. Transparency, we've mentioned this so many times now, it's getting dull. The accounts reflect the economic substance. So in other words, when we look at a set of accounts, we're seeing the true substance of all of the company's transactions. Full disclosure and fair presentation. So enough information to understand, number one, how it's been accounted for, but number two, understand the economic substance behind that transaction. Comprehensiveness, well again, we kind of mentioned this before, needs to cover all financial transactions. So all transactions with the firm need to be included in the accounts. Flexible enough to adapt to new transactions. So the purpose of this framework is essentially, if there isn't an accounting standard that exists for a particular transaction, we should be able to take the framework and apply it and come up with the correct accounting treatment that would reflect economic substance. So it's going to help as a guideline for covering transactions that are not covered by current accounting standards. And it's going to help, of course, in the development of new accounting standards. And consistency, transactions, of course, measured and presented in a similar way across companies to improve comparability and across time. So again, one company using the same principle over time. So number one, we want consistency. We don't want companies chopping and changing their accounting principles, but we also need the flexibility that they can change accounting principles if the economic substance has changed. And IFRS is very, very key, or very, very focused on economic substance. Always, 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 economic substance is the first thing at the front of IFRS. And that's not always the same with US GAAP. US GAAP is used to be a rules-based approach. Okay, so barriers or some barriers that we've currently got. And we've talked about one already. Now, we've talked about the valuation of things like PP&E and intangibles. US GAAP goes for historic costs, which essentially is purchase price less accumulated depreciation. Now, the benefit of historic cost is it's verifiable. It's very easy. You know, if I want to know the historic cost of a machine that you've got in your balance sheet, all I need to do is look up the invoice and see the amount leaving your bank account. So very little judgment. So it's very reliable, very verifiable. Now, fair value, the fair value is the current value of the asset, liability, etc. Now, fair value, unless we've got a very liquid market, so for investments, fair value is very easy to establish. Look up the current share price on the market, for example. But if we don't have a liquid market, then of course, it's going to require considerable judgment. Now, remember, we said that IFRS allows fair value to be used for PP&E. So you might have some land and buildings that are being revalued to fair value. Now, of course, the property market is a notoriously illiquid market with non-homogeneous investments. So therefore, a lot of judgment in valuing property. But the benefit of fair value is it's more relevant because it represents essentially the value of this asset at the current point in time. If the asset was sold now, hopefully we would receive consideration close to fair value. Now, again, to put these in context, think about two companies. One bought its property 100 years ago, the other bought the property maybe the same date, 100 years ago, but is revaluing. Now, of course, due to inflation, the company that uses the historic cost convention is going to have a very low value for its land and buildings in its balance sheet, but the company that uses fair value is going to have a much bigger value for its PP&E. So it's going to have significant impacts in the financial statements. Now, notice we're saying both IASB and FASB recognise that some elements should be measured at fair value. Now, remember, with international accounting standards, it's a lot more flexible. Essentially, certain investments, and we'll talk about which ones later on, are going to be at fair value, but also, of course, PP&E and our intangibles. US GAAP, it's really only certain investments. So more scope to report fair value under IFRS. And we believe fair value hopefully is more aligned to the true economic value of the asset and therefore is more relevant to decision making. Problem is, whilst that's helping us to report economic substance, it's reducing the reliability and the verifiability. So you do have a significant trade-off between reliability and relevance here. Standard setting now, principle-based. This is really our IFRS, our International Financial Reporting Standards, have been principles-based. In other words, they have few specific rules. What they have is that framework that we've discussed, and if you apply the framework to transactions, you should come up with the correct treatment to report economic substance. Now, US GAAP used to be more rules-based. In other words, there were certain rules that you would apply. Now, the problem with that is, whilst it's prescriptive, it's not very flexible. So you end up applying rules, and that might not reflect the economic substance of the transaction. Let me give you an example of where the two accounting standards used to differ. One was to do with special purpose entities. Now, special purpose entities, IFRS used to say, regardless of the share capital that you own, if you have all of the risks and rewards, it's a subsidiary of yours, you will consolidate it. In other words, bring in all of its assets, all of its liabilities. US GAAP used to, however, say you apply the bright line criteria, share ownership, when looking at consolidation. So you've got the scenario under US GAAP where essentially companies would set up a special purpose entity, ensure that they weren't the majority shareholder, and even though they had all of the risks and the rewards, they could avoid consolidation. Now, that has very much changed post-Enron. So there was this argument between legal substance under US GAAP versus economic substance under IFRS. As we said, accounting scandals such as Enron have caused US GAAP to change, and we're now really under US GAAP looking at a objective-based system where it's combining principles to ensure economic substance is reflected, but it's still using a larger degree of rules-based decisions compared to IFRS. Let's have a look at our measurement approaches. Our LOS asks us to identify our measurement processes here. So two potential approaches to take away. Either you focus on the balance sheet, get the balance sheet correct, in other words, measure your assets and liabilities correctly, in which case the income statement becomes an afterthought. The income statement, if you like, falls out of the balance sheet. It's the remainder of the double entry transactions required to keep the balance sheet balancing. Alternatively, you focus on the income statement, and if you focus on the income statement, you get that correct, and then the balance sheet becomes an afterthought. Really what they're saying here is either you focus on the balance sheet or you focus on the income statement. You can't get both of them at the same time. Okay, and that's what this point really here is saying. Standards regarding one statement will have an effect on the other, and the approach may conflict. Okay, and that's really because of the double entry bookkeeping process. The idea that the total of debits has to equal the total of credits. So either you focus on the balance sheet, get that correct, in which case your income statement is an afterthought, or you focus on the income statement, get that correct, in which case your balance sheet is a bit of an afterthought. Notice both US GAAP and IFRS tend to focus on the balance sheet. So get the assets and liabilities correct, in other words, the financial position of the company. That's the primary driver. The performance of the company, i.e. the income statement, is really secondary to this. Okay, so we're asked to describe the importance of monitoring developments in accounting standards. Now, of course, financial reporting standards are evolving rapidly, and as we've talked about, these convergence processes between IFRS and US GAAP are meaning new accounting standards and revised accounting standards are coming out all the time. Key point, of course, is the analyst really needs to understand how new accounting principles will affect financial reports and therefore affect their comparison between companies and the ratios that they calculate. So we do need to be continually monitoring, first of all, new products and transactions, because then we're thinking if there's new products and transactions, how do you report the economic substance? But of course, we need to monitor the standard setter and regulator actions, in particular, new accounting principles. Okay, so we need to keep on top of these because they affect the financial statements and therefore they affect our analysis. Certainly we can look at both the websites of the International Accounting Standards Board and the US Accounting Standard Board. Also notice CFA, here's a plug for the CFA, a little bit of self-advertising here, the CFA Centre Financial Market Integrity. Company disclosure, yes, the importance of company disclosure, that's really what we're focusing on here in this LOS, and it's analyse company disclosure. Now remember what we said, in the footnote disclosure, both critical and significant accounting policies must be disclosed. Now, that is absolutely essential for us to analyse, particularly if we're comparing two companies together. Are we comparing like with like? Have they adopted the same accounting principles for, let's say, their revenue recognition? If they haven't, then we wouldn't expect the accounts to be the same, and typically we'll have to adjust one company's accounts to move it in line with the other before we compute ratios. So very, very important that you understand how those accounts have been prepared. In particular, you're focusing on differences between different companies if you're comparing companies. Accounting estimates, well, again, it's the reasonableness, really. Are they reasonable? And are they consistent? So reasonable, consistent, and when we say consistent, we're really saying consistent between companies, but also consistent with the company, the same company, over time. So again, remember these accounts have lots of estimates and assumptions. We're going to encounter a few at level 1 and even more at level 2. Changes in accounting policy. If you change accounting policy, again, they're going to be disclosed. Changes in accounting principle. And remember, not only look at the footnotes, but look at the MD&A. Footnotes will talk about the change in accounting policy. In the MD&A, you're going to get a better explanation of why the company changed its accounting policy. Okay, so again, you're going to see disclosure and in the management discussion and analysis. Remember though, with the MD&A, it is unaudited, so we do need to be a little bit concerned about potential bias. So what are we focusing on as an analyst? Well, what policies have been discussed? What are the critical policies that drive their accounts? Have they covered, or have they given us the disclosure that covers all significant transactions? Again, if they haven't, then we'll be asking, well, how have they accounted for this particular item? Balances which require significant estimation. Okay, so where are the estimation? Where is the subjectivity in the accounts? We really need to be careful that that is reasonable and consistent. And again, have there been changes either to estimates or, of course, accounting policies? And if we spot that there have been changes, why have there been changes? Do they better reflect economic substance, or could it be financial statement manipulation? And again, we've got a reading on financial statement manipulation later on.